Week after week, the market is bleeding lower and lower. And if gold is also selling off and it's in a downtrend, then you could potentially sell short or buy an inverse ETF on gold. Just know gold will bottom, well before the stock market does. So you'd be more likely to want to short gold sooner and catch the first little bit and then maybe flip over to maybe doing some inverse plays on the stock market, because stock market can keep selling off for several months before, and gold will have already bottomed. And when gold bottoms first, just like I showed you on the gold chart, how gold has rallied first, when gold bottoms and starts to rally and the stock market's still going down, that's our early warning sign saying, okay.
As the market continues to decline, if gold is also in a downtrend, you could consider shorting gold or buying an inverse gold ETF. However, keep in mind that gold tends to bottom out before the stock market. Currently, prices surged to around $2,685 per ounce amid rising geopolitical tensions, particularly after Iran's missile strikes against Israel escalated concerns in the Middle East. When gold bottoms and starts rising while the stock market continues to drop, it's usually an early indicator of a market shift. ChrisVermeulen is a financial market expert and the founder of The Technical Traders, explains gold tends to follow long-term cycles, and the current one likely began in 2019. After a significant rise, gold is now in a multi-year pause, similar to the mid-2000s. During these pauses, investors often move to riskier assets like stocks. However, as market bubbles form, particularly in real estate, investors typically return to gold as a safe haven asset. As gold continues to rise and global financial concerns grow, it signals an upcoming correction in broader markets. Historically, ChrisVermeulen exposes when gold prices soar on their own without similar moves in silver or mining stocks, it can indicate that a market recession is near. Although gold typically pulls back during recessions, the decline tends to be smaller compared to other assets, such as stocks. Using Fibonacci extensions, the current technical analysis shows that gold is nearing its target level, and a market correction could be just a few months away, potentially leading to further gold price adjustments. Let's explore the video in more detail. If you're finding this content helpful, be sure to give it a thumbs up and subscribe to stay updated with our latest videos. Right now, only 11% of our viewers are subscribed. Help us hit our goal of reaching 1,000 subscribers by clicking that subscribe button.
Monthly chart of gold. So here's a really kind of good view of how the gold space kind of moves. I'm just going to zoom way out here. If we take a look at, so there's super cycles in commodities, and we started a super cycle back in early 2000s. We started a new super cycle over here in 2019 for gold. And these are obviously very, very big patterns. So a few things. So once you've started a super cycle, usually you have a nice run. And if we go back to 2006, 2007, we had a multi-year pause in gold. After it had a nice run up, it had a multi-year pause. And that's kind of where we are now. We've had a nice run up. We've had a multi-year pause for gold. And while gold has been pausing, money has been piling into the stock market. So money is like either flowing into risk-on assets, which everybody's piling into stocks. They're willing to take risk for big returns, or they move to a defensive asset like gold that doesn't pay dividends or anything. And so when gold is flat, the stock market is generally rallying and moving higher because people don't want to sit in gold. They want to go make money. So we have this very similar scenario. Now, what happened in 2007 is we saw gold break out of this and start to run. And there's all kinds of things happening. We have real estate bubbles. We have all kinds of PE ratios were out of whack. Things were overvalued. People are worried about currencies, stock market topping, real estate getting long in the teeth, meaning that bubble is coming to an end. And so people move out of all those assets and they start to move into gold. It's like its own asset, and it's outside of the financial system. And so when people get nervous, they move into gold. And this is an early warning sign. Gold to me is the global barometer. It's not just what Americans and Canadians are doing. This is like the whole world is getting nervous. And when gold moves up like this on its own, silver's not really following suit. Miners are not following suit. This is telling us we're getting close to a correction. And so we have been seeing that gold is on a tear. The world is getting nervous. We know there's bubbles everywhere. But what happens after this is the stock market will roll over. We go into a recession, and doesn't matter what it is, almost every asset will pull back. Gold pulled back 34%. And I believe we could see gold eventually pull back 25 or 35%. right back down into this pause mode, this kind of consolidation level, which is equivalent about 30-35% again. So that's the scenario of kind of what the world is doing, what gold tells us is kind of happening, how worried the world is, and the smart money. But gold is not like the safe haven play when we go into a recession. It will pull back. It might only pull back 25 or 35%, while the stock market might pull back 50% or 55, or growth stocks might pull back 60 or 70. But that's how I see gold unfolding and where we are in this overall cycle. And one other quick thing here, Danny, is if we use Fibonacci extension, which is my favorite tool, very, very, very accurate in terms of calculating where price should run. So you take a low, and then we take the high from 2011, and then we go to this low here. If we carry it forward, it tells us the momentum that gold had from this bullish leg up to its consolidation, to its pullback. My general rule is if gold or any asset, doesn't matter if it's gold or not, any asset comes up to the 618 level, which means that if it can rally 618%, and if it has a pause and pullback from that level, we almost always go up to the 100% measured move. So based on this run up here, the 100% measured move is the same measured momentum move to the upside. And so we have pretty much hit that. And that's where we are now. It's like, okay, this is the monthly chart. So every bar is 30 days, roughly 20 trading days. How many more bars do we have before gold breaks down? As you saw, it kind of took a year for gold to really break down. Now it did top right away, but it actually took like a year before it kind of broke that topping pattern and then went out of favor for a long time. So I think we're months, potentially a few months away this year, I think, from gold topping, the economy stalling, and all of that stuff. That's like my super high level basic view of things.
ChrisVermeulen highlights silver has more upside potential in the near term, as it recently experienced a rally followed by a pullback to the 618 Fibonacci level. This indicates the momentum is still intact, and silver could rise to around $34 and $35. This target aligns with previous highs and represents a strong resistance zone on the monthly chart. However, once it reaches this level, a pullback is likely, similar to how gold might behave after hitting its own measured move. It's important to note that while precious metals like silver and gold are often viewed as safe havens, they can experience sharp declines during major market sell-offs. As silver dropped over 60% during the 2008 financial crisis, far more than gold. Similarly, dividend-paying stocks, often considered safer investments, can underperform in market downturns as panic selling sets in. A financial reset is on the horizon, and ChrisVermeulen says, I believe gold could pull back to around $1,800 to $1,900. After this correction, once the financial markets and housing market, which is nearing a collapse, have sold off, this would present a prime investment opportunity. The last time gold and gold miners surged like this, it led to massive gains, potentially hundreds or thousands of % returns for those in the gold and silver sectors. Looking ahead, after the reset, gold could start a multi-year rally, with prices possibly reaching $3,000 to $5,000 due to factors like the global debt crisis and instability in fiat currencies. As fiat currencies like the US dollar face increasing pressure and digital currencies or gold-backed alternatives emerge, gold has the potential to skyrocket in value relative to the dollar. Let's get back to the interview.
Yeah, I think silver has a bit more upside potential. I mean, we've got these lows down through here. We've had this rally, and I love to use Fibonacci extensions for momentum. And more or less, we've seen silver, it had a run up, it had a pullback, it hit the 618, it's paused, it's chopping there. And I believe we're going to go up to 34 or so for silver. I still think gold can run up to 2750, I think fairly easily. I think silver is going to play catch up here and pop. I think we could see silver run to 34, 35, which brings us right into these previous highs. So not only is it a measured move saying that's where it should naturally run out of upward momentum, but it's also a very significant resistance area on the monthly chart. Not only did we have, it's hard to see on this chart, but we had a couple candle lows right through here on the monthly chart. We have 2 candle highs here, 2 more candle highs. You could say 2 or 3 candle highs here. So this blue line, this measured move, if silver hits 34, 35, just like, gold hitting that big measured move, I think most of the move is done. I would expect selling and for it to pull back. And silver pulls back a lot. In 2008, everybody moves precious metals as a safe haven play, but they don't realize, it falls over, silver fell over 60%, more, twice as much as gold pretty much. So there's precious metals are seen as a safe haven, but they're not actually a safe haven during times when you actually really need them. And people think the same with large cap, like blue chip stocks. You go look the dividend paying ETFs, the dividend stocks during COVID, dividend stocks sold off way more than the stock market did. And that's because the same group of investors, all the retirees, all the big money, they are all put into the same things. And utility stocks get hammered as well. People think these are safe haven plays. They're safe haven plays short term, just before a market sell off, they can do really well and hold their value. But once the sell-off starts, you're holding actually more volatile positions than just owning the indexes outright. It's crazy how backwards and advisors like push people into all of these plays, all because they can say, oh, you get dividends. And it's like, I don't care if I make 5%. If I'm going to give back 50% of it or more in these stocks, I'd rather just buy it back later. I don't care about dividends. It's when you go into a bear market, buy it later, and the dividends will be higher. And you can buy the shares at a fraction of the price. So, back to silver. Silver has got more upside. It's got about 10%, I think, from where we are right now. So I believe we're going to have a financial reset. So I believe gold is going to pull back somewhere down into this range, 2,000, 1,900, somewhere in there, 1,800 even. And then once we've had that reset and the financial markets have sold off, housing market is starting to decouple, which is on the verge of a massive collapse itself. Anyway, once we see gold and the market's correct, if this happens, to me, this is like the ultimate opportunity. This is something like really we were waiting for back over here. If you ever caught the gold miners run and gold back in here, it was epic. Right over here was absolutely game changing in terms of building wealth and excitement and like hundreds or thousands of percents on stocks in the gold and silver space. This opportunity over here and the one down at the bottom here is this. And I believe like this is where gold will be like, we'll start that next 4, 5, 6 year rally. And this time it could be a whole lot bigger percentage wise. It could be $3,000, $4,000, $5,000 very easily, simply because I think we have a lot going on with the debt problem and, fiat currencies generally always blow up over time. I feel like we're getting closer and closer to that. And, we got currencies all over the place in Japan currency, and people are wanting to come out with different digital currencies, gold-backed currencies. So how much longer does the dollar have? And if you look at gold and dollar standpoint, I mean, gold could really take off in terms of the dollar. So it'll be interesting.
Both gold and silver are poised for significant moves in the near term, with potential corrections offering prime opportunities for investors. While these precious metals are often seen as safe haven assets, their volatility during market downturns means caution is needed. A potential financial reset could propel gold to new heights, especially as global economic concerns and currency instability grow. How could the introduction of digital or gold-backed currencies impact the demand for traditional fiat currencies like the US dollar? Let us know in the comments section below. Also, ensure you like this video. Subscribe to the channel first and then watch the video, and turn on post notifications for more videos like this. Until next time.